Hello guys, welcome back with me. Don't forget to like, comment, share, and subscribe. As markets turn, investors hide in cash despite surging inflation. New York returns a tough year in markets is leading some investors to seek refuge in cash as they capitalize on higher interest rates and avoid changes to buy stocks and bonds at cheaper prices. The Federal Reserve has rallied markets in 2022 as it implements rate hikes in an effort to moderate the steepest inflation in 40 years. But higher rates are also translating into better rates for money market funds, which had returned virtually nothing since the pandemic began in 2020. That's made cash a more attractive hideout for investors seeking shelter from market degradation, even though the highest inflation in 40 years has dented its appeal. Fund managers increased their average cash balance to 6.1% in September, the highest level in more than 2 decades, a widely followed survey by both a global research showed. Assets in money market funds have stayed elevated since jumping after the pandemic began, coming in at 4.44 trillion as of last month, not far from their peak of 4.67 trillion in May 2020, according to Refinitiv Lipper. Cash is now becoming a viable asset class because of what has happened to interest rates, said Paul Knowles of Kingsview Investment Management, who said the portfolios he managed have 10 to 15 in cash versus less than 5% typically. It gives me opportunity in a couple months to look around in the financial market to redeploy if the market and the economy look better, said Knowles. Investors are looking to next week Fed meeting, at which central banks is expected to enact another jumbo rate hike following this week's consumer prices index report that came in hotter than expected. The S&P 500 fell 4.8% in the past week and is down 18.7% this year. The ICE, NYSE, ICE, both a United States Treasury Index is on pace or its biggest annual drop on record. Meanwhile, taxable money market funds had returned 0.4% so far this year as of the end of August according to the Crane 100 Money Fund Index, an average of the 100 largest such funds. The average yield in the current index is 2.08%, up from 0.02% at the start of the year and the highest level since July 2019. They are looking better and their competition is looking worse, said Peter Crane, president of Crane Data, which publishes the Money Fund Index. Of course, sitting in cash had its drawbacks, including the possibility of missing a sudden reversal that takes prices for stocks and bonds higher. Inflation, which stood at 8.3% on an annual basis last month, has also dented the upheaval of cash. Centrally, you are losing some purchasing power with inflation running at 8 plus percent, but you are taking some money off the table at a risky time for equity markets, said Peter Turris, president of Chase Investment Council. Your equities could be down 8% in 2 weeks. While an obvious sign of caution among investors, extreme levels of cash are sometimes viewed as a cold contrarian indicator that bodes well for equities, said market hackett nationwide safe of investment research, especially when taken in context with other measures of investor pessimism. Hackett believes stocks may stay volatile in the near term amid previous risks, including potential earnings weakness along with high inflation and the hawkish Fed. But he is more upbeat about the outlook for equities over the next 6 months. I think that's all from me. Don't forget to like, comment, share, and subscribe.